Which brings me to Josh Brown, who has made some interesting moves today that I wanted to have a little larger conversation about where we stand before I get to that. So, how long have you owned Alphabet, which you sold today? I'll talk about what you bought, or you can, but you've owned it for a long time.
Yeah, I had sold earlier this year half my position, which we talked about a couple of times on the show. I don't know where that was, in the 180s, the 190s. I sold the rest, and I think that Alphabet will be fine. Not everything is an extreme. I'm not in the camp that thinks Alphabet's going to lose the AI race, or it's got like this fundamental issue with all of these large language models taking away from the use of search. I think they will be one of the top AI services, but it's never had to compete the way that it does now. And younger generations are jumping literally right into ChatGPT when they want to know something. They're not looking for blue links and sponsored links and ads. They just want the answer. And so, like, Google's going to have to come up with an answer to that. And I think that's reflected in the multiple that the stock now sells at. I think other people understand that. This is not a unique insight to me. But I think it's going to be a defensive year. And I think, when you look at who is most reliant on advertising revenue amongst large cap tech, it's really Meta and it's Alphabet, and arguably the Meta moat around Instagram is stronger than the Google moat around Google search. So I think it's just that simple. I wanted to do something more defensive. And so what I bought instead of Alphabet in that category is Netflix. You want me to pause here so you can ask the question, or should I keep going?
Yeah, I mean, it was your final trade about a week ago. I guess exactly a week ago Netflix was. So maybe the writing was on the wall that you were looking at this name for a while, which has proven to be resilient relative to many of the other names in that universe, certainly of the larger cap, but not mega cap tech. But why? What made you finally buy that?
So it hit my list of the best stocks in the market a while back. I've been stalking it ever since. I've come to the conclusion that not only is it on the list of best stocks in the market, quantitatively, I actually think it's the best stock in the market for this year. That doesn't mean I think it'll go up the most, but I am not on the hunt for the hardest hit stocks to try to bottom fish. I'm not on the hunt for falling knives. I'm looking for resilience because I think in a defensive bear market, that's the number one quality of the stocks that by year end will have performed the best. So consider this. From the market top on February 19th, Netflix is down 5.9% going into today. The S&P 500 is down double that, 12%. The NASDAQ's down almost triple that, 15%. It's been a remarkable name in the tape this year. It's only 8% below a 52-week high. The median communication stock is 17% below the 52-week high. RSI is still 58. So in a market where almost everything's got a relative strength right now of like 40s, 50s, nothing special, this stock stands apart from almost everything else. There's a piece in the Journal that I think everyone should read about the discussion taking place at Netflix's annual business review meeting. They're talking about literally doubling revenue by the year 2030, which is only 5 years away. And they're talking about joining the $1 trillion market cap club. Market cap right now is about $400 billion. I think that this is the most defensible technology company, almost to the point where it's a consumer defensive stock. I don't think this is the type of service that anybody cancels. And even if they're thinking about canceling, the lower priced ad-supported tier will catch those people. And actually what's interesting is Netflix makes more money from the ad-supported tier than they do from a premium tier household. So I love everything about it. I don't think it's necessarily a cheap stock at today's price. Obviously, Alphabet's cheaper. I just think it's going to act more defensively and has way more potential upside.
It has, Joe, right? It has acted more defensively. It may not be, I think I asked somebody yesterday, maybe it was you, if it was recession proof. And I think your answer was it's recession resistant. Maybe, I don't know that anything in the market is necessarily recession proof if the market comes down, but Netflix theoretically would come down less potentially than some other names.
Well, think about consumer behaviors in a recessionary climate. What are you going to be doing less of? Less of going out to find entertainment and actually staying home to actually enjoy the entertainment that you have at Netflix. So I think in that regard, it is. And I think since April 2nd, Liberation Day, Netflix is actually higher. So there's the resiliency being reflected in this company. It's a classic example of buying something that appears to be rich in a valuation, buying something that appears to be high in terms of price and seeing it move higher. We have a 78% gain in this over the last year after purchasing it in April at around a little bit below $550. And at the time, some people looked at me puzzling for doing it, but I recognized clearly the fundamental chain that you had as it relates to being able to have pricing power with the price hikes, the ad tier subscription model, seeing the benefit there, and now you're seeing further evolution in terms of the technical. So Josh reaching for it here close to 1,000, I have no problem with that because I think this stock clearly takes out the 1064 high and goes to 1250.
I mean, Josh, we do have price target cuts for several of the mega caps today, including your Alphabet, or your former Alphabet. Meta, Amazon, Alphabet, all cut at Wedbush. I mean, there does seem to be a re-rating at the very least of expectations. And I think that's what you're talking about for these kinds of stocks in this kind of environment.
Yeah, look, one of the things that makes this moment in time so difficult is we're all so excited about AI. We all see it sort of like at the edges transforming our workflows and the things that we're doing professionally. And we have this kind of we have this sense that this is about to spill over into the consumer economy and just completely rewire all of the various tasks and work that we have to do and shorten the length of these things and speed things up. And it's exhilarating. So we have that on the one hand, but on the other hand, we kind of know that if the economy materially gets worse from here, so right now, if you're thinking about we're downshifting into like a 1 to 3% GDP growth world, and all this uncertainty makes it even worse than that, we don't have to have a horrific recession for it to be plausible that these ad-supported businesses are going to start to warn on earnings. Like it's very plausible. A lot of those companies that you posted in that graphic, they need the ad market to stay really strong. It's also plausible that AI spend could take a hit from all this uncertainty. There's news everywhere about a Microsoft abandoning an AI-related build-out in Ohio. It's not clear why they did that, but it seemed really sudden. Are there more of those, or is that like a complete aberrant one-off that's going to have its own explanation? I don't know, but I think that gets to the heart of why analysts are saying, look, we still love these businesses. We still think they have huge advantages and enduring moats and blah, blah, blah. 2025 just might not be the best year to own them. So that's the way I'm thinking, and I totally agree with the point that you're making.